welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Yeah, look, it's a bit larger of a revision than I expected. I was thinking more 500 to 600,000 down. Minus 818 is a bit larger. Again, let's just keep a couple things in mind. First is that instead of adding 2.9 million jobs in the 12 months up to March 2024, the economy added 2.1 million jobs. So instead of an average monthly pace of about 242, which is white hot, we still got a very, very solid 175,000 jobs.
Powell will try to send a calming message. I think that the Fed received, got a glimpse of what a disordered market reaction to recession fears would be earlier this month. So they will, tread very carefully looking forward. I think that Powell will deliver the message that the Fed is sufficiently confident that inflation is heading back to 2%, which will allow them to cut rates soon.
The consumer is still definitely feeling inflation. The consumer also has $700 billion of savings, and the labor market's tight, which is good because unemployment is at a low level. However, credit card delinquencies are up, and the consumer is feeling very stretched. So I think it's a real mixed bag.
We've got 1 hour to go until the market closes. So let's take a look at the major averages here, Josh. We've got a little bit of a rally, but sort of a baby rally, I guess. The Dow's only up 46 points, about 1/10%. The S&P 500 up about 1/3%. The Nasdaq up 0.4%. Now, in the absence of any other huge macro news, there are two things that grab the market's attention today. One is that revision to jobs going back 12 months from last March and seeing a decrease in jobs of 818,000. And the other is the Fed minutes that came out just about an hour ago that did seem to say, well, guess what? Some of the participants of the FOMC thought they should have cut maybe even in July.
Interesting. I mean, the data point, the big, revision to U.S. payrolls was interesting, Julie, because when it hit and crossed, you sort of saw this knee-jerk reaction. And then it kind of feels like as the trading day went on, investors thought, okay, you know what, actually, it's just more ammo, more reason to think the Fed does cut. And of course, it's backward looking, obviously. So investors are much more focused on what's happening with the labor market right now and ahead. And we all know already the labor market is cooling. Already unemployment is ticking up. We've spoken to at least some economists who are concerned about that, the pace at which it's been ticking up. But I think they just thought, a lot of investors concluding, more ammo from the Fed to get, less restrictive. And of course, all coming before Jay Powell speaks on Friday morning.
Yeah, so a couple of other asset classes to check on, reflecting all of that. Yields continuing to pull back a little bit, perhaps reflecting that outlook for what the Fed is going to do. A little bit of weakness in the U.S. dollar as well. That dollar weakness not helping crude oil, which is down another 1.5% today, $72 a barrel. And there where we have gold. Gold, it's not up much, but, it's been hovering near a record here lately, which has been an interesting trade. Yeah.
Yep. All right, let's get another voice on this, because joining us right now with more insight in today's data is Brett Ryan, senior U.S. economist at Deutsche Bank Securities. Brett, it is good to see you. I want to start, Brett, on that big revision to U.S. payrolls. I'm just curious, Brett, what you made of that. Was that about what you expected? Was it more?
Yeah, it was slightly more than expected, but overall, I think it doesn't change the Fed outlook very much. They had known the labor market was slowing. The pace of job gains at 175,000 is not all that different from the past 4 months, which is about 150,000. So one way to look at it is that whereas Fed officials maybe had thought you had a sharper slowdown from pace of 240,000 to 150,000 of late, it's more a picture of the labor market's been fairly steady over the past 8 to 16 months. And that squares with what the unemployment rate's been doing, and it helps to close that gap between what we were seeing in the growth of the household survey employment and from non-farm payrolls. So it solidifies the case for starting cuts in September. It doesn't necessarily advance the case for aggressive cuts off the bat, which the market is looking to get signals for.
So what's the next signal? I guess obviously we're going to hear from Jay Powell, and he's not going to have any more data than we have pretty much right now at his disposal before he speaks on Friday. And we will, yes, get another jobs report before the Fed next meets. Is that really going to be the number to watch?
Yeah, the upcoming labor market data definitely would be the more important one, I think. What Powell can say is, to affirm what we saw in the minutes today, and that's that the vast majority saw the case for cutting. The inflation data that we saw last week would support that. The labor market data that we've gotten has supported that. A sharper or a negative payroll reprint would argue for a more aggressive start to cutting, so maybe 50 versus 25. But at this point, I think there's not much he can say about the pay, where there's a preset course here, or what our cuts going to be going forward. And the minutes to the July meeting really emphasize that the committee doesn't feel that the committee wants to be very much data dependent and doesn't feel that it wants to outline a preset course here. So there isn't much he could say other than, what are the risk factors we're weighting, how they're viewing the balance of risks in light of the most recent data, and where that's leading them towards for September.
And Brett, I just want to go back to the unemployment rate for a quick second because, it has been ticking up, Brett. And we've had some economists on the show who expressed concern at the pace it's ticked up, but it doesn't sound like you share that worry, Brett.
So we've triggered the SOM rule, which obviously, there's been a lot of being spilled about that. But part of the reason why the unemployment rate has increased is more due to new entrants and re-entrants into the labor market as opposed to those who have permanent job losses. Typically during a recession, you see permanent job losses pick up more. So that speaks to a bit more of a labor supply story as the reason for the rise of the unemployment rate, and less about maybe a demand story, i.e., contracting demand for labor at this point. So we haven't seen layoffs pick up. And that squares with what the jobless claims data have shown. There was a bit of a recent rise due to specific factors around Hurricane Beryl. That's now starting to come off in the jobless claims data. So we haven't gotten that confirmation of a rise in jobless claims that would typically, in a recession, accompany the rise in the unemployment rate.
Brett, I'm also curious how the types of jobs that have been going away over the past year affects the perception of the job market, even how folks like us report on the job market, because a lot of them, professional and business services, the revisions that we learned about today, they were downward in things like professional and business services. Do you feel like that sort of colors because it's so-called white-collar jobs, that sort of colors the perception of the job market?
Well, I think we have to remember within professional and business services, you have temporary help services, and you also have administrative and waste services. So I wouldn't necessarily say that category, it's a catch-all category for a lot of different industries. Retail trade was one that saw sizable downward revisions, as did leisure and hospitality. So I don't think it's necessarily that the type of job losses, downward revisions at least, that are impact how we're thinking about it. What you do see, though, during a typical recession is layoffs at the lower income spectrum, and that's what we haven't seen yet. So I wouldn't say that we've seen a white collar loss of jobs necessarily. Again, these are just revisions. We haven't had a loss of jobs really, at least a large increase in permanent job losses yet. So, I don't think there's much to say in terms of the sectors at this point.
Brett, I want to get a quick comment from you. I thought it was an interesting sort of analysis I saw from Peter Bukvar over at Bleakley Financial this morning, Brett. He was talking about that revision of U.S. payrolls. And to Bukvar, he was telling his clients, listen, I think this is sort of evidence of a problem he thinks the Fed has in relying on data that gets revised, Brett, again and again, right? Revised multiple times. Bukvar telling his clients, because of that, he says, I'll argue again, the Fed should be removed from the business of setting the overnight Fed funds rate. Let the market do it based on the supply and demand for money. What do you make of that analysis, Brett?
That's an interesting one because the market can remain, irrational far longer than you and I can remain solvent. So I would discount that. And I think the Federal Open Market Committee looks at more than just the non-farm payroll report when setting its policy. As Chair Powell has emphasized time and again, they look at the totality of the data, and the fact that you've had private final demand. As solid as it's been over the past several quarters, the fact that you have jobless claims where they are, that tells you that, they're not relying on just one data source. It's when you have conflicting sources of data and, non-farm payrolls being as strong as they were prior to the revisions was one sort of outlier relative to other employment series. Now you have much more continuity, I think, across those employment series. And so, I don't think that they're setting policy on one or two reports, and they're looking at the totality of the data. And when the totality of the data says that you're still expanding, maybe not at a aggressively above trend pace, but you're still expanding nonetheless. It makes sense with an still elevated inflation to go slowly in terms of removing restriction.
Brett, it's always great to get your insight. Appreciate it.
Pleasure. Thanks for having me on the show, Julie and Josh.
Thank you. And by the way, be sure to tune in this week as Yahoo Finance heads to Jackson Hole, Wyoming for the Fed's 2024 Economic Symposium. Our own Jennifer Schonberger will be sitting down with Fed officials and government leaders this Friday, August 23rd, with that beautiful Jackson Hole backdrop. I'm always so jealous of that beautiful Jackson Hole backdrop, Josh.
Who wouldn't be? All right, we're just getting started here on market domination. Coming up, big day for big retailers, Target, Macy's, and TJX, all trending following their latest earnings reports. We'll speak to an industry expert on the other side, take a closer look at what the results say about the consumer. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned. Much more market domination still ahead.
You can't price out of the markets have priced pretty much have split the difference between a 25 and 50. I would do 50. I think you got to get the funds rate to 4% quickly. And, you can't. I was looking yesterday at credit card delinquencies or charge-offs, auto loan delinquencies. Like, you're starting to see numbers that approach financial crisis. Not there yet, but you're starting to see this significant increase. 5 3/8 when you've got inflation running. I mean, I was looking at 3-month moving average. A bunch of the metrics are under 2 now, are under 2. 5 3/8 when you got inflation running, let's say 2, the wrong price. Like, get it to 4, which is still restrictive. So could they do it? I think they should. Do I think, you have enough difference of opinion on that committee that they probably will say, let's compromise and do 25s consecutive meetings? I think that's Jan's base case, and that seems right to me.
That was BlackRock's Rick Reeder, who joined our Opening Bid podcast earlier today. For more on the Fed's next move and what it means for investors, we want to welcome in Michael Sayers, Rockland Trust Vice President and Portfolio Manager. And Jay, there's always this discussion about what the Fed should do, what the Fed is going to do, what the Fed should have done. People love to have that one. What do you think the Fed is going to do, and what are the implications for the market?
Well, good afternoon, Julian. Thanks for having me back on the show. I think Rick's right. I think the Fed is ultimately going to start with 25 basis points in September. There's definitely the argument to be made, as Rick was laying out, that they could start with 50 if they think they have to move faster. But Jay Powell has shown that he really likes to build a consensus on the committee, and when they move, they like to move unanimously. So I think ultimately they're going to come down with a 25 basis point cut in September.
And what's your take on the overall health of the U.S. economy here? We had, of course, Mike, that kind of growth scare. We saw the panic selling off that last jobs report. Then you got some more economic data points, and it seemed to give investors obviously more confidence. But what is your take?
Sure. So my take for pretty much the whole year has been, the economic momentum, has been strong. It is slowing. And the consumer is slowing as well, but the consumer is still not weak by any means. So ultimately, though, I do think sooner or later, hopefully sooner, we are going to need some Fed rate cuts to stabilize the economy, especially if we want to see a reacceleration in GDP in 2025. I think what's really keeping the economy afloat this year is just the amount of fiscal support that we're getting. So we're still running the budget deficit at 7% or so of GDP. The Biden administration has been forgiving student loans. They also just restarted a legacy pandemic era program, the employee retention tax credit. So that's giving money back to small businesses that kept employees on during the pandemic. So they've been kind of pulling out all the stops to keep the economy running. But sooner or later, we're going to need lower interest rates to reaccelerate here. Hopefully next year.
And one of the other things we heard from Rick Reeder is that he's going long some volatility strategies here. After that spike in volatility we have, it's come back down. But some of the factors that you've just been talking about maybe could result in more choppiness. So is that a strategy you would also take a look at?
So long or short volatility is really not a strategy in our playbook.
Gotcha.
So we're a very long-term focused strategic asset allocators. We're building well-diversified portfolios for our clients, based on their time horizon and risk tolerance. So we would approach it a little bit differently. If volatility resurfaces, we're active managers. So we're going to be using that opportunity to, buy or sell stocks and bonds that we think are more or less attractive. And if there's a larger dislocation in terms of equities selling off, that may give us the opportunity to do a strategic rebalance and potentially move some from bonds to stocks if stocks significantly underperform. So that's how we would approach it with our clients.
Mike, the Democratic National Convention going on this week. We can compare and contrast now Harris and Trump, at least on some policies, at least economic policies. I'm curious how much of a topic of conversation that is with your clients. Sure.
So politics is always a topic, especially during an election year. I think for Harris, I think a lot of her economic policies are not going to be too different from what we have come to know and come to expect from the Biden administration. And of course, you compare contrast that with Trump, who's going to be much stronger on something like a deregulatory agenda, which could benefit industries and sectors such as financials and industrials and some of the more cyclical companies. But Trump also is probably going to be a lot stronger on the tariff side of things. So it's unclear whether that's going to result in higher inflation and slower economic growth, or not here. But at this point, I don't think Harris's policies are too much different from Biden's. But as we get closer to the election, I'm sure Harris will, might want to distinguish herself a little bit going into November.
Mike, great to have you on the show. Thanks for joining us.
Thanks very much.
Retail in focus on Wall Street after a batch of earnings reports ahead of the opening bell. Target surpassing Wall Street expectations in the second quarter. It was a comeback quarter, delivering a beat on earnings. However, the company still remaining cautious with its full-year sales guidance. Meanwhile, from Macy's, the retailer reporting a year-over-year decline in net sales amid a challenging consumer environment. Joining us now is Storch Advisors CEO and former Toys R Us CEO Jerry Storch. Jerry, it is good to see you. So let's start with those earnings reports, because different reactions there. Macy's, Jerry, cuts the forecast. The stock is getting crushed today. I'm curious, Jerry, what you made of that report, and just more broadly, what it tells you about that department store sector.
Look, I think all these reports have been very consistent. I like to say it's an open book exam, and the results from the earnings we've seen over the last 2 weeks are very consistent. The consumer remains stressed. They're leveraged. They're running out of pandemic money, and inflation has been hurting their ability to spend on discretionary items. So let's take Macy's, which you're asking about. Macy's is a little more of a luxury spend. It's a choice whether or not you need to shop there and spend that money. Meanwhile, today we also had TJX reporting, and TJ Maxx's numbers were the mirror opposite. They were excellent today. So their comp stores were up 4% for the quarter, and their stock also did quite well today. So TJX is the off-price discounter that's kind of been eating department stores alive, and you see that in each of their results today, and also reflective of the state of the consumer looking for value and finding it at an off-price as opposed to traditional department stores. We see the same thing with Target. Look, Target did well compared to how they've been doing. This is the first quarter in like 5 quarters or something that they've had positive same-store sales. So kudos to them. That's great news. But meanwhile, their comp sales gain at 2% was pretty tepid when you realize that Walmart just last week posted a 4.2% same-store sales gain, more than double Target's. And on the internet, Target was up around 9%. Walmart was up 22%. So Walmart is absolutely crushing it with their strong value, low price message. And Target, who's trying to get that back, they lowered a lot of prices. They're emphasizing that. Did better than they've been doing, but still lags a lot. So we're seeing a consumer who is looking for value, and every piece of data that comes out supports that.
I want to linger on Macy's for a moment, Jerry, if we could, right? Because I think what you're saying about the macro picture for the consumer is important, but I think we also have to consider the individual execution of these various retailers. And I thought it was interesting that Tony Spring, the Macy's CEO who just took over in February, said they are 2 quarters into a 3-year plan. When you looked at the stock reaction today, I wonder how patient investors are going to be for that 3-year plan.
Well, that remains to be seen. There was a takeover attempt against the company, and you may know I was affiliated with that, so I want to be quite open in disclosing that. And management rejected that. The stock went up, on the offer. Now it's back down basically to where it was beforehand. So it's done the full cycle there. And Tony's a new CEO. He's got some great ideas. He's got a great track record. We'll see whether or not he can pull it off. But really, there's not a sort of 1-year issue here. This has been going on for decades in department stores in general, and Macy's specifically.
Jerry, I'm wondering if I was an investor and I was listening to this conversation, would you just stay more opportunistic with the big box retailers right now? I mean, you mentioned Walmart and maybe you'd throw Costco in there too, Jerry. Just those names that offer a lot of different kinds of stuff and they're focused on value. Do they seem very well positioned to you to capitalize on where the consumer is at right now? Consumers, you mentioned, just seems more discerning, selective, focused on what they need rather than what they want.
Look, I think that those are good names. You're absolutely right. I will say I've been talking about the same four companies. It feels like forever. I'm sure it's just a couple of years, but if you listened and done that, you would have done great. And those four companies are Walmart, Costco, TJX, and Amazon. And that represents the people who are doing it right, hitting it out of the park, expressing value. And then with Amazon, you have, of course, the by far, by orders of magnitude, the internet leader. So those companies, in my opinion, are going to do well in good times and bad. And if things are a little worse than they appear to be at this point, they're going to be pretty protected on the downside because they represent value to the consumer. And again, take a look at over any time frame. You're going to find out those would have been fantastic investments. And that's true about Walmart, who's one of the best performing companies this year.
Jerry, I keep alluding to this podcast we did this morning with BlackRock's Rick Reeder, and one of the other interesting things he talked about is how the 55 and older consumer is really the spender. I mean, we've been talking about the higher income cohort, but he was saying specifically it is that age cohort that is kind of keeping spending going here. And I'm just curious your thoughts on that and the capability for that to keep going.
Look, I think you got to be careful when you say that. And obviously, older people have more money. That's been true since the dawn of mankind, and then they tend to leave it to their kids. That's a demographic fact that would be true. But if you don't do well with a younger income consumer, with a millennial, and below, then you don't have any future. Then it's just like the rabbit swallowing the snake until there's nothing left, or the snake swallowing the rabbit. I'm sorry, until there's nothing left. So you have to do well in both cases. When we talk about the consumer, though, and I just have to say this, sometimes I just want to scream at the television set, or when people say
your
the consumer.
opportunity, Jerry.
Scream away, Jerry.
You can scream on the television set.
I'm not going to be that untoward, but I will simply say the consumer isn't as healthy. Everyone say, the consumer's been so healthy. Look, take a look at retail sales year over year. For the last 2 years, there's maybe been 1 month out of 2 years where the pace of growth of retail sales year over year has actually exceeded the rate of inflation. So and you've got the chart there. That's probably the 1 month up there. That I think it was December of that year, the higher number there. But in almost all cases, inflation's been higher year over year, the CPI growth, than the rate of growth in retail sales, which are not adjusted for inflation. So when we keep saying, the consumer's great, sales are, I'm like, they better be up, because inflation's up. So consumers feel like, and in fact, it's true, that they're spending more money and getting less. That's exactly what's happening. So even when we have fairly benign inflation, like we see now. So last month, I believe the CPI was up something like 2.9%. Retail sales were up 2.7%, less than the rate of the CPI growth. And everyone says, the consumer spending, what a great month, for consumer spending. It was still less than inflation. That's been going on now for almost 2 straight years since way in the pandemic, when consumers are spending like crazy, even when inflation was so high. So that's what's really going on. And all that money that they are spending, it has to go for necessities first. So that means food, which has seen, strong inflation. It means rent, which has seen big increases. It means healthcare, those kinds of expenditures. Not so much left over for discretionary spending, like apparel, for example, or department stores, which we were talking about earlier. Not so much these days for homes, for building
well, to be fair, Jerry,
not so much for furniture.
To be fair, the prices of some of that stuff has actually come down or moderated a lot more. I mean, CPI also includes services, right? It doesn't just include stuff. And apparel prices have kind of been okay comparatively.
Well, I know, but if you still look at the rate of inflation, the units sold haven't kept up. And so basically, it's been almost entirely price increases that have driven the retail sales that we've seen. You can pick or choose and say, well, eggs are up 1 year and not the next, or whatever there was there. But when you see the kind of inflation that we've seen, you have to realize people are spending more and getting less, and they know it. And you could also say, well, maybe some of that increase was for healthcare or for rent or something, and not for physical goods, and it's not so bad, except they still don't have the money. And so what money they have left over, they have to spend on necessities. And that's why the discretionary categories have been suffering so strongly, and why consumers don't feel that great. Yeah. And again, I just keep saying, I hear it and I go like, you're telling me now, if I give you $1 and then I go, I'm going to inflate that by 20%, and then the consumer goes out and spends $1.20, then the consumer's strong. because it's up 20%. That's
Yeah.
just ridiculous.
Yeah. Well, I'm glad we gave you the opportunity to yell at the TV figuratively, Jerry, and to share that important view. Thank you. Appreciate it.
Thank you.
Time now for some of the trending tickers that we're watching on Yahoo Finance. We were just talking retail, and this is a retail-related story. Walmart unloading its entire stake in JD.com. This bringing an end to an 8-year partnership between Walmart and the Chinese e-commerce company. Not affecting Walmart very much, but it is affecting JD shares. And, JD, along with some of the other Chinese e-commerce companies, has kind of been struggling here. And so this is just another sort of blow for them.
Yeah, analysts will point out, Julie, Walmart intends to focus on its operations as well as Sam's Club in the China market. And if you look at JD, I mean, the stock is well in the red this year and over the past 12 months. It was interesting just reading the reports when the news broke that, clearly some were raising kind of broader questions. What, if anything, does this mean for about foreign investment? Is it a sign of, broader retreat now? What do bulls say on a day like this? It's interesting. You'll find a lot still on JD. Team at Jefferies weighed in, said they're still fans. Bottom line, their opinion, delivered a solid set of earnings results, competitive moats intact, margins intact, they say, but bulls obviously on their heels in today's trade.
Yeah, I mean, JD's sales, though, last quarter just grew 1.2%. So it's interesting in this moment. At one point, retailers were salivating for any kind of opening into the Chinese market, whether it be through partnership or directly. It was viewed as really key. And that has fallen back to some extent for some, maybe retailers, some other industries, it's a little spotty, but it's just interesting as Chinese growth has faltered.
Not the rebound
It's become
that
less
COVID
important.
a lot of people had expected, for sure.
Exactly.
Our next trending ticker, shares of Keysight Technologies climbing after beating third quarter earnings expectations. Look at that move. Fourth quarter guidance beating the street as well, 13% right now. I mean, broadly, Julian, investors are trying to make sense of the tech spending backdrop right now as businesses try to kind of navigate the macro. So the company reports, delivers a Q4 forecast at the midpoint, did beat consensus. Also reported Q2 results that beat. Stock is moving here. Biggest intraday pop, by the way, since August 2019 for that name.
I mean, to put it in perspective, first of all, the shares have not done much of anything this year. And secondly, even though the numbers beat, revenue was down year over year. It fell in their, and this is, by the way, they make measurement instruments. Their electronic industrial solutions revenue was down 20% year over year. Communication solutions revenue down almost 8%. So it's not, this is one of those less worse situations, I guess.
I think the CEO also, I thought this was an interesting comment in this nugget where he said the funnel of opportunity supports our outlook for second half orders to be above first half orders, followed by a more gradual recovery in 25. And I think investors kind of latched onto that.
Well, that's helpful when you have an optimistic comment. Let's talk about our next trending ticker as well. Franklin Resources shares moving sharply lower. The co-CIO of its Western Asset Management unit taking an immediate leave of absence. He got a so-called Wells notice. Ken Leach is the gentleman we're talking about here. He manages Western Asset Management. Again, it's a unit now of Franklin Templeton, but it was one of the sort of original big bond management funds founded on the West Coast, right? Yeah. On the West Coast, you have a bunch of these bigger funds that were founded in Southern California. PIMCO is another one of them. And so this is a storied firm here, but he got this Wells notice basically that says the SEC is looking into your trading. And specifically here, how those trades were allocated in some of the client accounts. So this really a blow here because, this kind of business, it's relationship based.
And he's a true vet.
It's trader skill based. So, it matters when this happens.
Firm responds closing its macro opportunity strategy, names Michael Buchanan sole CIO. To your point, though, I mean, the stock's now down about 30% this year, Julie.
Yes, it is. Parent company Franklin Resources. All right, coming up, several big pharma names stand to make big bucks from the boom in GLP-1s, but which other companies stand to win or lose from the wonder drug's big potential? You can find out in our latest edition of Goodbye or Goodbye. That is next on Market Domination. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. We're looking again at the GLP-1 trade, but we're taking a little bit of a different tack. Beyond the pharma giants dominating the space, what's the best way to play it now? I'm here with Matt Higgins, RSC Ventures CEO and co-founder and returning Goodbye or Goodbye champion. So let's
Oh, champion! I didn't get the prize.
Everybody who comes back is
I love
a champion.
that. All right, let's do it.
So let's do it. Let's talk. I mean, we know the big ones, right? We know the Novos and the Eli Lillys. Let's talk about Viking Therapeutics, which is your goodbye here. The stock is already up a little bit of a 250% year to date. So there is some money coming into this name. But talk to me about why you think that this is a good prospect for their GLP-1.
Yeah, this is a remarkable company. We all know what Eli Lilly and what Novartis has done, but it's a massive TAM. It's a $150 billion market, and this is a biotechnology firm, probably like 30 people, and they are onto something pretty amazing. They're working on two products. One is a shot that you would take once a month, and the other is a pill, which is the holy grail, and early studies show that it's being very well tolerated.
Now, some of the big guys are working on that stuff also. Is it just that you think the science behind this one is, and the studies are particularly encouraging?
Yeah, they're actually very encouraging. So they're meeting with the FDA later in the year to accelerate towards a phase 3. But the early data that they have released shows a high degree of tolerability. And if you're able to reduce it to once a month and a pill, that'll dramatically increase the number of people that are using it. So all the early science is very, very promising.
And of course, if the big pharma guys can't develop them themselves, maybe they can buy it.
Time to go on a shopping spree. So that's the bottom line. There are multiple ways for Viking to win. I mean, the thing is right now it's a $7 billion market cap company. Your Eli Lilly is on its way to a $1 trillion company fueled by Mounjaro and Zepbound. So to be able to acquire this company, I think, I'm gonna put it out there, for $15 billion is relatively nothing considering the opportunity. So it's a prime acquisition target, but you don't only have to win that way. There's a catalyst coming up.
Let's talk about that catalyst in November. What's happening in November?
So there is a big conference around obesity that takes place in November in Texas. I think it's November 5th. Last year at that same conference, they released early stage data. There's a lot of speculation. They're going to update this early results to show how the tolerability is going around the pill and around the shot. So that is a catalyst that I believe the stock will continue to drift up towards that event.
Interesting. All right, so let's talk about what could go wrong potentially. It could take a long time. I mean, it does sometimes take a long time for this stuff to get to market.
Something like 50% of phase 3 trials fail. So we could all wake up one day and I could lose all my money. There's that. It takes a long time to commercialize. It takes billions of dollars to be able to manufacture this. I think this is like 30 people, 7 PhDs. So it's going to be hard for them to commercialize. However, they could go ahead and partner with any of the number of the big players, Merck, Pfizer, who don't have a drug right now.
One other question too is, since the stock has already had a lot of upside this year, I mean, yes, you've talked about the potential for big stuff here, but how much of that is priced in with that, more than doubling?
I don't think it's priced in at all. I have a tremendous amount of my personal money in it. I don't think it's priced in at all. The consensus targets range anywhere from 75 to 130. There's a lot of whispering around what that takeout number is, around 120, 130 a share. I don't know how people come up with this, but I don't believe it's priced in at all. I think it's still relatively early.
All right, so let's get the flip side of this, and it is Dexcom. The share's already down year to date, I think about 25, or no, more like 40% or so, excuse me. Dexcom plays in the diabetes space.
Yeah.
And we have seen this sort of inversion of the other side of the GLP-1 trade, is that a lot of these diabetes-related companies have gotten hit.
Yeah, we're in a fascinating cycle where they get hit and then they come back again. Medtronic, some of the other ones, sleep apnea. So what do they do? They do continuous glucose monitors. Anybody who doesn't know, you put it in your arm, it measures your blood sugar level. I've used it before, I've invested in them. Here's the thing though, there was a study that came out last week from Eli Lilly that showed Zepbound reduces the prevalence of diabetes over a 3-year study of 94%. Like, we might be in a world where we are eliminating type 2 diabetes, and that is very bad news for Dexcom because its revenue is entirely concentrated on these continuous glucose monitors.
Is there other stuff that they can do with the same technology?
I don't think so. The growth. So in their last earnings report, the stock got pummeled because they came out and they said 50,000 customers didn't materialize. Now, they had said in their earnings call, it's because we restructured our approach to sales, and that's why they didn't show up. It has nothing to do with GLP-1. That's what all the snack purveyors say. Our numbers have nothing to do with GLP-1. We're still in that phase. I think they're way too centralized to pivot. Most importantly, they're valued at 43 times future earnings. The market projects 20% growth in revenue. I don't see where that's going to come from.
And that's an interesting comment you just made too. Whether you're talking about Dexcom or the food business, do you think a lot of them are sort of in denial about the impact of GLP-1s?
They are in denial because I know I'm in denial. I own a lot of food businesses, and we're like, we're going to be fine. Sugar is all the rage. So the truth is, I'm dealing with it. And when you're in a business and it's not possible for you to make a hard pivot, you rationalize and justify. I've seen it at board meetings all across America for the last 2 years. But this company in particular is especially vulnerable.
Okay, let's talk about the last point here. Organizational disarray. Is that why they're also especially vulnerable?
I just think when something doesn't pass the smell test and you're basically saying you made a simple change in how you handled your sales, I won't get into the sales channel strategy, something doesn't add up. And that's what their explanation was for their last report around why 50,000 customers didn't materialize. Now we see this report from Mounjaro and Zepbound, and you realize, oh, this must be early warning signs of people saying, I don't need the continuous glucose monitor because I'm feeling better. I used it myself when I was heavier, and I would never put it on again.
Huh, interesting.
Yep.
All right, well, let's talk about what could go right. There is that drop in the shares already. And the other thing I guess I would ask, Matt, is, how long is it going to take for there to be really this big mass penetration of the GLP-1s to have a big effect? I mean, isn't this going to take a while?
That's a great question. And I always say you want to make sure your thesis is investable or it's not going to take too long. This is different. We're seeing all the direct-to-consumer companies now trying to use a loophole with compounding to go direct-to-consumer at lower prices.
Right.
It is becoming pervasive. Everybody has a Ozempic face, right? Like we're talking about. I don't think this is going to take too long. I also don't think it's priced in because the multiple is 43 times and the S&P typically historically trades at 18 times.
Right.
I don't think this is going to take a long time at all to play out.
Matt.
Could be wrong, but I think it's goodbye.
But you're putting your money where your mouth is.
I
in this
am.
case. And are you short this
I am
stuff?
short this through puts, and I am long, long, long Viking.
Okay, Matt, great to see you. Really interesting stuff. We love talking about this story here.
Thanks for
Appreciate
having
it.
me.
And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
All right, let's get to some calls of the day now. B of A Securities downgrading American Express from buy to neutral. The note citing limited upside for billings volume growth. Analysts didn't really love the valuation either on this name. That was another big point. But they say they are favorable, actually, on Amex's execution and strategy. No problems there long term. But this was interesting. Recent commentary, they say, from retailers and travel companies suggests the spending backdrop is challenging even for the high-end consumer. And they go to a hold and the sidelines, Julie.
I mean, Bank of America has a lot of credit card data at its disposal, and so the analyst there cites
American
that
Express,
as well. No, Bank of America as well, sort of comparing it to what Amex is seeing. So they say that. First of all, the analyst notes Amex partner Delta noted that extra seats added this summer are not getting filled. So that's one of the areas where they're seeing that weak demand. And they say this is consistent with that Bank of America aggregated credit card data that showed spending on travel was down. Amex is one of those products that's known as being particularly tied to travel, tied to business travel, but also leisure travel to some extent. So that also caught my eye, that like zeroing in on travel and what's going on there.
In a soft landing environment, though, so they moved to the sidelines on this name. So what do they actually like? I thought it was interesting. They see stronger upside opportunities in that soft landing environment in names like Capital One and Synchrony. These issuers trade at a lower PE multiple relative to Amex and are likely to see larger improvements in sentiment.
Interesting. Yeah. All right, well, coming up, we're taking a deeper dive into home builder stocks in today's Yahoo Finance Investor Playbook. Stay tuned, more market domination still to come. Despite market volatility in recent weeks, home builders have held steady, with several of the largest names staying in positive territory. However, these companies are still at the whim of several factors, especially interest rates that heavily affect new and existing home sales. With just a few minutes left till the closing bell on Wall Street, we're looking at how to navigate home builder stocks with the Yahoo Finance Playbook. Joining us now is John Lovallo, UBS U.S. Home Builders Building Products Equity Research Analyst. John, it's good to see you here. So we've come out of the earnings for many of these companies. I thought one of the interesting trends that we saw is that even though, for example, some of the profitability metrics improved, many of them missed a little bit on orders. Talk to me about some of the cross currents here affecting the home building industry.
Sure. Thanks for having me on, Julia. And I appreciate the question. Yeah, it was an interesting quarter, and I think it was a very telling quarter in the sense that the home builders, which have been very focused on driving volume, and look, they're production builders. That's what they do. That's part of sort of the game here. But they showed some restraint this quarter with the interest rate volatility, and what they did is they, instead of pushing forward with incremental incentives, they kind of stayed back a bit, kept pricing very consistent, and were able to drive margins higher. And so I think it's that pace versus price type formula that builders are always trying to optimize. And I felt like they did a very good job this quarter in doing so.
Talking about the issue of affordability, John, how you're thinking about here with the 30-year fixed at 6.46.
Yeah, Josh, it's a great question. Look, I think where the public builders have really excelled is in their ability to attack this affordability problem by offering things like mortgage rate buydowns. So if you're buying a home from a public home builder, you're not paying, the 6.5% that's out there right now as a headline rate. You're paying probably between 5% and 6%, and in some cases even lower. And that is a tool that these folks have in their toolbox that the existing home market cannot compete with, and frankly, the smaller private builders can't compete with either. The size and scale and captive finance arms attributable to these public builders is a real advantage.
And John, what is that tool, though? What does it mean for the margins of these companies?
That's a great question. It is certainly an impact margin. Rough rule of thumb, I would say every sort of 100 basis points of buy down is about 300 basis points of margin. Now, that's already contemplated into the outlooks of these companies. And in fact, I would tell you that I think that there's likely upside to margins here as rates have pulled down a bit. It's less expensive to buy down when you're not buying down quite as far. And so I think that there's actually positive movement in margins if rates kind of stay where they are today or in fact go even lower.
So, John, put it all together with us for us with specific names here. Who you think is sort of best navigating this environment?
Sure. I mean, we still believe that the entry-level first-time buyer is most active and will remain most active in the market. With that in mind, D.R. Horton is our top pick. They are the largest builder by volume by a margin of call it 15%. They go to market with the lowest average selling price. They have the size and scale advantages that I spoke about, which helps with materials, with procurement of labor, things of that nature, which are very important in an effective and efficient build model. So that's the one that I would say is our top pick. We're pretty bullish across the group, though, to be perfectly honest with you, Julia. I do believe, though, that sort of entry-level first time is where you want to be positioned most optimally.
John, what about a name like Toll as well? You like that move. It's already, John, it's a big move there. I mean, up nearly 40% this year, up about 90% in the past 12 months. What moves that one higher, John?
Yeah, I mean, look, we still think this group, and we argued this pretty extensively in numerous reports this year, we still think this group is really positioned for a valuation re-rating. You're looking at a group that's trading at under 11 times earnings versus the market, closer to 20 or whatever it may be at this point. Now, I'm not saying that this group deserves a market multiple. It is more cyclical, but it deserves a premium to where it is traded historically. And this is because it's generating solid cash flow throughout a cycle now. It has taken down debt significantly, so the balance sheets are in pristine shape, returning capital to shareholders, much less land intensive than they were in the past, and just really consistently executing. So we believe that there is room for multiple expansion, but you don't have to count on that. I think estimates are continuing to go up across the group. We're still working through our model now with Toll Brothers, but I would say that relative to consensus expectations, I would say estimates are likely to go up. And that has been the case over the past year with this group. And if with interest rates coming down, if that is in fact the way things go here, there's going to be more upside to estimates across the group.
What is the biggest limiting factor to capacity growth at this stage, to them building more homes and therefore making more money?
That's a really good question. And look, it's also not necessarily negative. In a cyclical industry, what causes the peaks and troughs, as you know, is generally overproduction. And one of the things that's been a governor on growth has been labor in the construction industry. But maybe just as importantly, or more importantly, is at the municipal level, the ability to get land entitled and permitted to build upon is just a very slow and tedious process. And so even if builders wanted to put the pedal to the metal here and build more, there would be some constraint on that. And so I think that there are factors that are, not easily solved, quite frankly, that are still out there.
John, always great to have you on the show. Thanks for joining us.
Appreciate it, guys.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
the closing bell on Wall Street, and now it is market domination overtime. We are joined by Jared Blicker to get up to speed on the action from today's session. So let's start with where the major averages ended the day. Really not seeing a lot of action, particularly for the Dow. Not necessarily true for some of the other majors, but if we look at the Dow, up 55 points on the day, almost 0.2%, trading in sort of a tight range over the course of the day here. Remember, as we talked about, the two sort of big data points that people were looking at today were, one, the jobs revisions this morning, going back 12 months from last March, which cut off 818,000 jobs. Still doesn't seem to be a lot of alarm on the part of economists that changes the picture materially going forward for the job market or for the Fed for that matter. The S&P 500 up about 0.4%. We also got the minutes from the Fed's last meeting that seemed to indicate indeed a willingness to cut in September. Not that that is a shock, but still the confirmation of that somewhat reassuring to market participants. And the Nasdaq up 0.6%. And Jared, I have a feeling you're going to go Russell, maybe. I thought I saw you playing around looking at the Russell ahead of time because we saw outperformance from the small caps today.
Yes, we did. And I'm going to show you something interesting. This is a one-day look. Let me show you a two-day look of the Russell. And you can see it just kind of took off after about 1 p.m. yesterday. Now I'm going to show you the VIX. VIX is trending up too over the last 2 days. Very unusual or slightly unusual to see the VIX trending up with stocks. And then if we take a look at, for instance, the Nasdaq, that's a lot more choppy action. That's not a solid trend, but nevertheless, it looks like a very steady, gently sloping uptrend right there. So again, the Russell 2000, the real performer here, and that matching the VIX. I want to show you what's going on with WTI crude real quickly. Year to date, it has almost come back to the break even, and it has been going down several days in a row. That is despite the US dollar going down as well. Normally the dollar would act as a tailwind, but not in this case. It is acting as a tailwind for gold futures, which are, I believe it's another record high there. Have to check that when I get back to my desk. But let me show you some of the heat maps here. We got consumer discretionary, that's XLY. That is the leader today, followed by materials, that's XLB. Only financials in the red here. And if we take a look at our leaders, nothing in the red. We did see Korean stocks briefly just a few minutes ago, but everything closing in the green here. Let's take a final look at the Nasdaq and some mixed action with respect to the mega caps, but more green, a lot more green than red throughout the field here, guys.
Thank you, Jared. For more on the markets, we're joined now by Lori Heinel, State Street Global Advisors Global Chief Investment Officer. Lori, it's good to see you. Interesting day in the markets, Lori. We had that big revision of U.S. payrolls. It's sort of a knee-jerk reaction when that print hit. And then it seems like investors perhaps, Lori, concluded, you know what, maybe that's just more ammo, gives the Fed more reason to cut next month. What did you make of it?
Yeah, I think that that's right. We've been saying for a while that we thought that the Fed was poised to cut, and we've actually been a little surprised that they haven't moved earlier. But I think they were looking for confirmation that they'd gotten inflation under control, and we've seen a number of prints recently that confirm that inflation numbers are coming down. And there was a pivot towards focus on the labor market and the fact that there was vulnerability there. So we think, if anything, the print today actually just underscores the Fed's need to act.
And Lori, it's Julie here, by the way, and it is fantastic to see you again. Are you in the sort of 25 or 50 basis point camp, though, based on that labor market data?
Yeah, we think they're going to do 25. There's nothing that suggests that there's urgency here. We would prefer to see them move a little bit more aggressively. And we've been saying for a while that we thought that the big risk here was that the Fed fell behind in terms of cutting rates and that was creating restrictive conditions in the economy a lot longer than it was necessary. But we think there's really nothing that's going to push them right now. We do, however, think that that means they will move more through the course of the year, and maybe as much as 100 basis points before the year is out.
Is your base case, though, Lori, is it still a soft landing backdrop?
It is, but it really is dependent on, does the Fed actually follow through on easing monetary conditions through this cycle? We actually have soft landing as our base case. We obviously think there are still risks that it's something harder or that there's even recession. And a lot of the dependency is going to be, does the Fed continue to modulate policy in conjunction with slowing growth and abating inflation. And again, that's not a one-way trade. We think there will be moments where inflation may continue to rear its ugly head. But really the story is, how do you promote growth against a backdrop where growth is slowing? And that's going to require additional rate cuts.
Lori, do you think, though, that the Fed is going to continue to be data dependent, although maybe less inflation data dependent now and more labor market dependent? And do you think that there's going to be some choppiness in the market if the Fed says, okay, we're cutting now, but we're not definitely going to keep cutting?
Yeah. No, they have to remain data dependent. That's been the way that this Fed has operated under the Powell administration really since the inception. So for them to abandon that would create other challenges for market participants. But as you note, the data is likely to be a bit more contradictory as we move forward. I think the labor markets will be the focal point here. So as long as labor markets remain resilient, then they can take a more measured approach. But let's just say, if growth is, sub 2% and inflation is sub 3%, there's no reason why rates should be north of 5%. So they've got a lot of opportunity here. And we think they will take that measured steps. And I would agree with you that labor will probably be more of the focus going forward.
Lori, so those are your views on the Fed and the economy. Add it up for us. How do you therefore want to be, positioned in your portfolio?
Yeah, well, we're still constructive. We still are a little overweight on equities because we do think that there's a bit more room to run here, but we think that we're going to see more breadth in the market. And we did see earnings come in, away from the Mag 7 being positive for the first time in many, many quarters. So that was a constructive sign. If the Fed does take this measured movement towards reducing rates, we think that the soft landing scenario is intact, and that gives us more confidence. But I would also say that at the margin, we have been paring back our overweight to equities because we don't think that it's going to be the kind of one-way trade that we've seen. And we do have a lot of potential for volatility, which we saw earlier this month.
One of the areas I also understand you like is financials, which is interesting. We haven't, that's not been a buzzy group as of late, even with the outlook for rates coming down, which I guess advantages financials in some ways and disadvantages them in others. Why now for that particular group?
Well, there are a couple of things. First and foremost is the relatively attractive from a valuation standpoint. Generally, rates coming down a little bit gives them a bit of kind of pricing power against the backdrop of that, so that could be pretty attractive. And again, the sort of worst case outcomes of really hard landing, really a lot of consumer stress, those things we don't think are going to materialize. So all of those potentially provide the opportunity that they release some of those reserves as well. So again, it's not a screaming buy where you load up the buses here, but at the margin, we do think that there's room to run there.
For fixed income investors listening right now, Lori, what's your guidance? What's your advice there?
Yeah. Well, first of all, we think fixed income is going to be the most important part of the portfolio to get right over the coming years. So we are encouraging clients to deploy cash into longer durated fixed income. We also are focusing right now more on rates because we think there's more of an opportunity to catch a move in rates and get some capital appreciation versus in the credit markets. But make no mistakes, we think overall fixed income is very well positioned to do well for investors over the coming year.
Lori, great to see you. Thanks a lot. Appreciate it.
Yeah, nice to see you. Thanks.
Coming up, Zoom Video Communications out with their latest earnings report. We're going to get you those numbers on the other side when Market Domination Overtime returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Looking now at shares of Zoom after the company came out with its second quarter results. The shares up by about 3% here. Revenue a little bit ahead of analyst estimates, but the real beat here comes from earnings per share, $1.39 versus the $1.22 that analysts had been anticipating. The company's third quarter forecast for earnings per share and full year forecast for earnings per share both ahead of estimates. The company raising actually its forecast for full year. Also the news coming that the CFO, Kelly Steckelberg, frequent guest here on Yahoo Finance, is going to be resigning from the company, and that they have started a process to identify a new CFO here. So that's the other big piece of news coming out.
Just looking at some other customer metrics, 3,933 customers contributing more than $100,000 in trailing 12 months revenue. That is up about 7% from the same quarter last fiscal year. They say approximately 191,600 enterprise customers. A couple themes on the call to watch. Will be more questions about Zoom's AI initiatives with its so-called AI companion. Helps things like draft emails and summarize meetings as well, Julie.
Yeah, the shares, by the way, are down about 16% year to date.
Down about 10% over the past 12 months.
Yeah, I mean, you and I were talking during the break. There is perhaps no other company so synonymous with the pandemic and being a pandemic.
Would you put Peloton in there, though?
I think Zoom even more. I really do, because what it created remained, right? The idea of video calling being much more part of our daily lives, our business lives, but it's just that it itself was not able to continue that momentum and capitalize on that expanded use of video calling. I mean, Teams getting some of that market share.
You got to compete against big names with deep pockets.
Exactly,
that gets a lot tougher.
So I'm just looking at the 5-year chart of this thing. I mean, it peaked
That's remarkable.
500.
Look at that. Yeah.
$500 above $500. So it's just been such a fascinating story to watch. But this was a good quarter.
Pop it in the after hours.
Yes. All right, JD.com, one of the top trending tickers on Yahoo Finance today after Walmart sold its stake in the Chinese tech giant. Shares coming under pressure, but the news did not drag down the broader sector. Joining us now, Brendan Ahern, CraneShares Chief Investment Officer. The focus is on China. And Brendan, it's been so interesting here, the Chinese e-commerce business, not just JD, but Alibaba, PDD. They've sort of been in this three-way race over there. And it's a somewhat tough environment in China. How are you thinking about the sector?
Yeah, domestic consumption in China, Julie, has certainly been constrained by the scar tissue of zero COVID, what the Chinese population went to, conversely, what we went through here in the United States, as well as the downdraft in real estate prices. Really the first time for Chinese investors where upwards of 2/3 of urban household wealth is invested in real estate. For the first time ever, those real estate prices have come down, and that's really weighed on the domestic consumption story in China. And as you mentioned, weighed on the e-commerce plays like Alibaba, JD, and Pinduoduo, as well as new entrants like ByteDance, TikTok in China, Douyin. So it's been a tougher space, but we're starting to see some green shoots there, particularly around Chinese government policy to try to potentially stimulate domestic consumption, which again has been quite tepid.
Brendan, when this news hit, it was interesting because you kind of reading through the reports, and there was talk of what, if anything, this said about foreign investment in China. Was this a sign, a signal of, the start of some broader retreat? I'm just curious to get your thoughts on that, Brendan.
Yeah, I think ultimately Walmart and particularly Sam's Club are doing very well in China. And they've made this partnership over 8 years ago, this investment in JD. And ultimately, Walmart is doing so well that they no longer need a partner. If anything, Walmart is kind of encroaching on JD's core e-commerce business, not only just on offline traditional retail stores, but with Sam's Club and their e-commerce efforts. So I think this is not really an indication. Walmart is not giving a thumbs down on China's economy. They're really saying we have enough bandwidth to go alone, and therefore we're in this almost frenemy relationship with JD, and we've moved on beyond it because we've done so well.
Is that unique to Walmart, or as the relationships with from other U.S. companies, as they've matured in China, do we also see them sort of becoming more independent and strengthening?
early on, Julie, the government really required
Right.
many of these Western companies and American companies to have a local partner, say General Motors with SAIC, a big automaker there. They were kind of forced to do a joint venture. You fast forward to today, you have companies like Tesla operating independently in China without a partner. Certainly Nike operates a lot of factories without a partner. So I think there's been this opening up, these reforms over several decades in China. And I think that's reflective of Walmart's ability to operate independently today, similar to Costco as well in the retail space.
Brendan, can I get your thoughts on just the overall health of the Chinese economy and what you see now, but also what you see going forward? I mean, there was some expected, Brendan, really sharp, strong rebound out of COVID. Instead, you have economic data that seems to point this picture of an economy that's still, having a tough time gaining real, meaningful momentum.
Yeah, 100%, Josh. There was this belief that this revenge spending was going to take place after zero COVID. And again, the fall in real estate prices, as well as the conservatism of the Chinese consumer because of this proverbial scar tissue. I mean, people have money. They're just being very conservative in spending it. And then I'd say at the same time, China's export-driven manufacturing has been really, really strong. And that's really an indication that the global economy and the U.S. economy is doing well. And I think there's some indications of why the Fed might need to cut rates potentially is because of a slowing U.S. economy, which means the government has to make a pivot to raise domestic consumption. They've given some support to both electric vehicles and as well as home appliances to try to spur more consumption in those two areas. But I think a broader fiscal policy on consumption is coming. They've just been very hesitant to create more debt, potentially create inflation by giving away free money. The government's been very conservative in that. But it's time for the baton to get handed away from export-driven manufacturing to domestic consumption.
So if we do start to see some more of those kinds of incentives, I mean, I have to say, I look at KWEB, right, which is the CraneShares China Internet ETF, which includes a lot of these things that we've been talking about. It's been tough this year, right? And it's been tough over the past year. Do you think that government intervention in domestic consumption is what is needed to help that sector recover?
Candidly, it's been a tough 3.5 years.
Yeah.
So it's been a tough place to ply your wares, but we are seeing these green shoots, Julie, where they had this big government policy meeting about a month ago, the third plenum, and they don't create policy there. The importance was the government acknowledged that there was a problem, and I think that avoids potential policy area, that they didn't gloss over the issues. So what we need now is actual definitive policy. They need to raise consumer confidence. It's been very, you see this huge, the greatest bond rally ever is taking place in China. But I think you need the consumer to come back here just because we anticipate export-driven manufacturing is going to slow. You got to raise domestic consumption to offset the weakness that will be coming. And they've just been very conservative. They saw the effects of free money policies in the West, the amount of debt and inflation it created. But I think the market is saying we need more. We need this fiscal policy support. And again, I think as readers of the Chinese economy, we're seeing some amplification of policy as well as acknowledgement of the issue. So fingers crossed the proverbial cavalry is coming in terms of policy.
Brendan, final question on politics. Interesting. I don't know how her views on China. I haven't really heard her elaborate on that, yeah. Brendan. Maybe she just moves in lockstep with Biden. I'm not sure. Obviously, with Trump, it's tariffs. You hear him, Brendan, talking about wants to revoke China's most favored nation status, talks about stopping Chinese investors from buying U.S. farmland. I'm just curious, as an investor who knows Chinese economy and markets so well, Brendan, how you're thinking about that.
Yeah, I would agree, Josh. We don't know exactly what a President Harris policy would look like. Potentially a continuation of Biden, who arguably has been harder on China than Trump. Now, in terms of Trump, our belief is that some of this rhetoric is not reality. This is the art of the deal. Trump was actually able to do something that Biden didn't do, which is actually do a deal with China. Just was obviously derailed by zero COVID. I think 60% tariffs, if you think that's actually coming, I recommend shorting Amazon, Walmart, Costco, and Home Depot. The effect that 60% tariffs would have on U.S. inflation, on U.S. consumers would just be a modern day Smoot-and-Hawley. It would devastate the U.S. economy. And that's why we don't believe that's reality. We just think it's part of a negotiating tactic. And I think China, just as they did previously, Trump is more than willing to do a deal again.
Brennan, great to have you on the show as always. Thanks for joining us.
No, thank you very much. Thanks, Josh, Julie.
Time now for what to watch Thursday, August 22nd. Starting off on the earnings front, another day, another new batch of retail earnings. This time I'm going to hear from Ross Stores, Dollar Tree, and BJ's, among others. Ross reporting second quarter results after the close. It's been a mixed bag so far for retailers. Consumers continue to spend, but are more diligent about finding the best deals. Analysts expecting Ross to top revenue estimates with better brand expansion at lower than normal markups.
And taking a look at the labor market, we'll get new weekly jobless claims numbers in the morning. Economists forecast that number will increase to 232,000. This coming after the Bureau of Labor Statistics, remember, revised down net payroll gains for the 12 months ended last March by 818,000.
And finally, the 2024 Jackson Hole Economic Symposium kicks off tomorrow with the revised jobs data showing a weaker than expected labor market. Wall Street will look for any clues about the size of a potential rate cut in September. Our own Jennifer Schonberger is sitting down with Fed officials and government leaders on Friday, August 23rd.
I wonder if she has her cowboy hat already.
She better.
Ready to go.
Well, now that you said it, you put it out there.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. A likely September cut. Minutes from the Fed's July meeting show officials deem it appropriate to ease policy at their next meeting. Some even considered a cut in July. This as revisions from the Labor Department indicate job growth has been far weaker than originally thought, helping bolster the case for a September cut. Stalling out. Ford is cutting back on some electric vehicle plans. The car maker is canceling upcoming releases and reiterating its commitment to hybrid technology in the near term. Is it a savvy business move or ignoring the inevitable electric future? We're going to discuss that next. Plus, hurricanes, wildfires, flooding, and uptick in extreme weather events calls for more climate-resilient infrastructure. We're going to talk with the CEO of water management leader Advanced Drainage Systems about the opportunities ahead. Ford is revamping its electric vehicle strategy. It's scrapping plans for its next lineup of all-electric SUVs, replacing them with hybrid models. It's going to delay the introduction of a new large electric pickup truck by about 18 months, but it is adding plans to introduce a new electric delivery van in 2026 and a new electric pickup in 2027. For more on what this strategy means for the automaker, let's welcome in Autoblog editor-in-chief Greg Migliore. Greg, it is great to see you. So it sounds, Greg, big picture, like CEO Jim Farley, what he's saying is here, listen, we got to get to work. We need a new EV strategy here, try and reduce these losses, and actually launch products down the road that we think can turn a profit. Is that the 30,000-foot view of what's going on at Ford?
Hey, Josh, great to see you. I would agree with that assessment. And to break it down a little bit more, I think Ford knows there's certain areas where they can absolutely win. And one of those is trucks. With SUVs, crossovers, three rows, they have a little bit more of a kind of a scattered record. But they know, hey, with trucks, that's an area they could win. Now, did they delay the next generation of the F-150 Lightning, the electric one? Yes. However, I think that's actually okay because the current Lightning is very competitive. Delaying that, a year, 18 months, I don't think that's going to definitely change the landscape because, frankly, there's not that many electric trucks like the Lightning out there. So that's, I think, a practical move. I think kind of jettisoning the three-row SUV that was going to be all electric, I think that's a little bit short-term thinking. I think that really could have been an opportunity for them to get into a segment that not many other automakers are. Like when you look at the Kia EV9, that's a tremendous electric three-row crossover. There's not many others out there at that price point. So I think that was a good spot for Ford to try to get in and maybe win some new customers. But Jim Farley is a very practical CEO. I think he may be the most practical and one of the most decisive CEOs in any industry. And I think he said, hey, I got to make a tough call here. I'm going to go with the trucks versus the crossovers.
And it seemed like investors did like the move in the news, Greg. I'm curious, how does Ford, if you look at the kind of broader EV market, Greg, how does Ford actually stack up against, the Teslas, the Hyundais?
So Ford has a solid sort of like bookended strategy. You've got the Mach-E, which is an electric Mustang crossover, a lot of different versions of it. And I think that gives them a bit of a gateway. It gets people really excited about the idea of a Ford EV. And then, of course, you have the F-150 Lightning, which is, the electrified version of, their top-selling pickup truck. So they're good in two spots. It's everything in between where I think they have some opportunity. Hyundai has a great lineup with the Ioniq 5. Kia also has a strong portfolio. And now we're seeing some more pressure from just across town. General Motors, with their Chevy brand, is launching the Blazer, the Equinox EV, the Silverado EV. They're very good products. So I think right now Ford must be willing to concede a little bit of that to try to focus on hybrids and make some hay in the near term.
Consumer interest in EVs, Greg, we've talked about this, not as hot as it used to be. I'm just curious whether you think that shifts, that changes in the near to intermediate term here.
I don't see a big shift, especially for the rest of this year. I think perhaps as the 20s roll on, you could see a little bit more growth, perhaps as new products get out there. But there's a fair amount of uncertainty in the segment. But right now is a pretty good time to buy an EV. I mentioned some of the new Chevys. Volkswagen has the ID.7 coming out. Mercedes, a little bit of a higher price point, offers plenty of EVs, and the infrastructure is getting better. It's still frustrating, I think, for a lot of folks, but it's not a bad time to try to get into the EV space if you're interested.
Greg, Ford, they also said they would provide an update in January. What did you make of that call? What's behind that, do you think?
I mean, I think, quite honestly, they're waiting to see the results of the election. Trump has said that he would likely end the $7,500 federal tax credit for EVs. Vice President Harris has said that it looks like she would likely continue President Biden's EV strategy. So I think, for most of the automakers, they're kind of looking to see which way, the coin falls.
Final question, Greg. We talked a lot about EVs. What about hybrids? Still as hot as ever?
Hybrids are hotter than ever. It's funny because this is a technology that, going back 10 years, this is what people thought was going to sort of change the industry. It would get more people into fuel-efficient cars as we moved away from V8s and V6s. But now they're, I would say, easier to use. You don't really have to charge them unless you get a plug-in, which works in some situations, and they're just easier to use.
Greg, always good to see you. Thanks for joining us.
Thank you, Josh.
Meanwhile, the S&P 500 Nasdaq closed higher as Fed minutes signal a likely September rate cut. Yahoo Finance's Josh Schaefer joins us now.
Hey, Josh. Yeah, so we got our takeaways next to me today, and I want to start with retail. So Target up over 11% on the day, largely from results that were better than expected. And I think that's been one of my big takeaways from retailers. We've had retail earnings over the last week. And I want to just take a look at some of the market action we've been watching in that retail space. So consumer discretionary was the leader today. I have it set to 11 days right now. We're looking at 11-day performance for the sector. Consumer discretionary has been one of the only two outperformers of the S&P 500 in that time period. And Josh, I just want to pull up our retail board because I think this is quite interesting here. So this is the last 11 days. This is when we've had most of retail earnings. You're seeing a fair amount of green on your screen here, and you're seeing some pretty big pops over the last 11 days too. You're looking at Walmart off their earnings report up about 11%. Costco is outperforming the S&P 500. TJ Maxx, Nike, Shopify, and I guess I throw all of this there to say, this doesn't look like a market that is pricing in a significantly slowing down consumer that investors are severely worried about, right? These are a lot of stocks that are related to the consumer. And if the market's doing this, maybe the consumer is just kind of doing okay. It's not doing great, but maybe we're all right.
Was your takeaway a consumer that's maybe a bit more cautious? Because we heard that a lot.
And I mean that's what
that's
what management's been saying, right? I mean we heard that from Walmart. I think we heard that to some extent from Target as well. But that's what we've been talking about for a year. We've really been talking about a choosy consumer for over a year now, where we're sort of in this, is it going to get worse standpoint? And I'm just not sure if we leave this set of retail earnings with any more clear sort of look at that. It seems like we're still in the choosy phase.
I mean, we've had analysts come on the show and say, listen, I've been banging the table for a year on the same names. And it does often come back to the big box retailers. The names, you sell a lot of stuff, a lot of different kinds of stuff, and at value, and that seems to be where they're finding the consumer.
Well, you flip it to a year, right, and you look at stocks that if I told you a consumer was choosy and where are they going to go, they probably go to a Walmart and a Costco, right? And so those stocks have played out. So it's been interesting to see that market action, but of course, there's a lot more going on, right? We got to flip to our second takeaway, Josh. So we got job revisions. So the BLS does job revisions every year, we should mention, and normally people don't make as big of a deal about them. So I think that speaks to a little bit how concerned we are about data right now. But so the revision today showed that in the 12 months ending in March, we had 818,000 less job additions than we thought. That was the biggest revision in 15 years. You can see bigger than we've seen in recent years with this chart. But from my conversations with economists leading into this print, their reaction after, largely it was, okay, sure, things were a little bit slower than we thought, but if you were to take the monthly average numbers that we had gaining, you go from about 240,000 monthly ads to 175. 175 is a pretty good pace, economists say. Like the economy went from maybe very good to good in terms of the labor market, and they're saying this is what the Fed's looking at. And this hasn't changed, and this is a recent trend, right? We're looking at the unemployment rate in recent months, now up at 4.3%, your highest level in almost 3 years. This is what the Fed's focused on in those Fed minutes that you reference. This is what they were talking about, right? They said that risks to the labor market have been increasing. So the Fed's already sort of focused on the labor market, and people don't expect the revisions we saw today to necessarily change what we hear from Jerome Powell on Friday.
In other words, revisions backward looking, and we've all been talking about a labor market that's cooling for a while, including this uptick in the unemployment
Yeah, I mean,
rate.
think about where those revisions ended, right? They ended in March. If you look here, this is where all the action's been, and we didn't learn anything about what's happened between March and now in that data today. So it's really just not necessarily recent enough to take too much from it.
I thought, what did you make? The investor reaction was interesting too, because it hit and you saw kind of a knee-jerk response, and then it almost felt like investors decided, well, okay, more ammo for them to cut.
Yeah, it seemed like people priced in a little bit more of that 50 basis point cut, right? Like we saw that move a little bit.
Yeah.
But overall, the market didn't move that much, which I think normally tells you how much people are caring about a data release, right? The people that are sitting on their desks trading based off this stuff looked at the release this morning and said,
okay,
no narrative changed. And our final thing, the AI trade. So this was an interesting one that we were watching today. Big Bear AI is a AI company. It is not an overly large stock. I got to flip over to our AI board here. It's not an overly large stock, but they got a defense contract. So if I equal weight this for us and I put it to intraday, it's going to come up in the top left because they had a very big move. Stock was up 27%, and you can see it really hadn't been doing all that much. Big move today. It's up 40% over the last 5 days. But what I found interesting, Josh, so this company has this announcement, and I'm just kind of thinking about the AI trade. And I'm like, where are we at? What's been going on? Last 11 days. Look at all that green. Look at that green. So the S&P 500 is up about 8%, give or take, in the last 11 days. So that gives you all of these outperforming the index over that time period. People have been piling into some of these AI trades. You look at like a SoundHound. This is an AI trade that has been perhaps a little bit speculative at times, right? It pumps when other AI trades are pumping. That's up. You look at BuzzFeed is up. Again, Big Bear AI is up. It just seems like a little bit more maybe risk on in this sector of the market.
And of course, the face of the AI trade, NVIDIA, reports next week. We'll see
Let's
what that
pull
means.
it up. Up 23% over, it's actually up more than that, I think, maybe in that 11-day period. Yeah, 23%, a little bit over. They report next Wednesday, and I think that is going to be key for if we keep seeing this trend of people wanting to buy the other AI companies that can benefit from that build-out, or are we starting to hit a moment where the market doesn't really love this trade? Final thing, last month. This was not a loved area, right? So this is really a new theme that we've seen kind of come back in. It'll be interesting to see if
that earnings season, you heard those clown giants telling you, they're going to spend. So it'll be interesting what Jensen Huang has to say about it.
How does NVIDIA benefit from that spending? Big question.
Thank you, Joshua. Coming up, Advanced Drainage Systems CEO joins us live from the New York Stock Exchange on the other side, asking for trend. It continues after this. Advanced Drainage Systems is building up its leadership position in protecting and managing water, announcing plans to acquire septic treatment company Orenco Systems. And between infrastructure build-out, residential construction, and extreme weather events, the company has plenty of other catalysts on the horizon. Joining me now is Scott Barber, Advanced Drainage Systems CEO, and of course, our very own Julie Hyman. Scott, it is good to see you. Scott, I just bought a house in New Jersey, and this week, my basement flooded, Scott. So I feel like it was meant to be you on the show and talk about this. I want to start, Scott, actually with your earnings results, because it's the first time we had a chance to catch up and talk about that. You did report, Scott, maybe what the street or some of the street were hoping for on the top and the bottom. I was hoping you could just walk us through that report and the trends you're seeing in the business.
All right. Well, thanks for having me this afternoon. You're not the first person I've talked to that's had some flooding issues since I've been here in the tri-state area, and I'm sorry to hear that. Well, we announced a couple of weeks ago our first quarter earnings, and we had very nice growth in several of our segments. The infrastructure segment up 19%, roads, highways, airports. Our non-residential segment up mid-single digits. Our residential segment up mid-single digits also. Agriculture down some. But I think it really speaks to the diversity of end markets that we serve in the construction industry and in the water space to have that kind of overall growth and be up 5%. The profitability came in on plan. It's the second best quarter in terms of margin percentage that we've had in the company's history, only preceded by last year's first quarter. So we're right on plan where we thought we would be in terms of our profitability. Our sales are in good shape, both volume and geographically and segment-wise.
Hey, Scott, it's Julie here. I, too, live in New Jersey, although luckily, knock on whatever wood's available, did not have basement flooding this time around. But I think that question sort of speaks to the issue because it's not unique to New Jersey, right? As we get climate change, there's a lot more water in a lot more places. I think of a place like Miami, for example. And so talk to me about the effect on your business and how you guys have had to adapt and maybe the demand that you've seen as a result of that.
Okay, well, I'm glad you didn't have water issues, Julie. And this really speaks to our promise, which is to protect and manage water, the world's most precious resource, safeguarding communities and the environment. And that's really what we're all about, specifically in the stormwater and this on-site septic. And what's happening here is the frequency and intensity of rain events is changing. And there's lots of different studies that show this. And what's happened is the water infrastructure is not really ready or prepared or caught up with that change in frequency and intensity. And it tends to be more pronounced on the coast or in Houston. You mentioned South Florida. That's another area. And what's the effect on our business is really, I would say over the medium and long term, is a rewriting of the stormwater management codes and design rules that would really increase the capacity of these systems and these solutions to handle more rainwater in a shorter period of time. South Florida has done a lot of this. Houston has done a lot of this. You see the money coming through in the IIJA. Those monies are going to systems like airports that are increasing their capacity to handle stormwater. Those are our products. Those are our solutions.
Scott, I'm curious with the election here, how much does it matter to your business who's in the White House, who controls Congress?
It's really interesting. Good water management, clean water is a bipartisan issue. Everyone wants clean water. Everyone wants a neighborhood that doesn't flood. Everyone wants a community that has good stormwater management. So honestly, I don't think that it's really, however it plays out, is going to have that much effect on what has to happen to improve the stormwater infrastructure. The EPA recently released a study that said that over $600 billion of new water infrastructure investments need to be made over the next 20 years. That's stormwater, wastewater or septic, that's drinking water. And we can't wait. We can't wait on that. And I think bipartisan support is really there for these kinds of issues.
Scott, finally, you guys also are a big plastics recycler. Talk me through that part of the business and how it kind of fits in.
Okay, we are. We're the second largest recycler of plastic materials, 540 million pounds. We do this at scale across a very large network. We really got into this probably 15 years ago and using recycled material in addition to virgin material. There's a lot of engineering that goes into this, a lot of material science to do this in very high volume like we do it. And it honestly started out as an economic type of thing. And it's still an economic type of thing where recycled material is lower in cost than virgin material. But about 4 years ago, we began to reposition the company around water and being a good steward of the environment, particularly water. And this recycling fits very nicely into it. I tell people we manage the world's most precious resource, water, and we do this with this super high recycling content. Over 50% of the material we consume in making our products is recycled.
Scott, great to have you on the show today. Thanks for taking the time to chat. We appreciate it.
Thank you. Have a nice evening.
Let's take a look at what's trending after hours now. Urban Outfitters posting its second quarter results. Adjusted earnings per share topping estimates, and net sales for the 3-month period came in line with estimates, increasing 6.3% to a record $1.35 billion. The retailer seeing beats in revenue across its Free People and Nuuly brands, helping to offset a miss in Anthropologie sales. Snowflake posting a better than expected second quarter, company surpassing the high end of its second quarter product revenue guidance. As a result, Snowflake now raising its product revenue outlook for the year to $3.36 billion. That's compared to expectations of $3.33 billion. And turning to Synopsys, the software company beating estimates on the top and the bottom lines in the third quarter. Synopsys boosting its full-year revenue and earnings forecast, as well as expecting a record of full-year revenue with growth of about 15%. We're going to be speaking with the Synopsys CEO tomorrow afternoon around 3:30 p.m. to break down that report. And coming up, fall is in the air this August with a fan favorite drink coming sooner than usual. More asking for a trend on the other side. For our chart of the day, we're looking at stocks versus bonds and Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Hey there, Josh. Well, this was inspired by Kevin Gordon, friend of the show over at Schwab, and he tweeted about this chart today. He was comparing the S&P 500 to the 10-year yield, the 10-year Treasury yield, and he says, if you go back to the beginning of 2023, each time we saw a pullback and rebound in the S&P, it happened at the same time that there was a surge in yields. In other words, when yields went higher, that seemed to be bad for stocks. And he said the rebounds then that happened in stocks happened after you got a rollover in yield. So we just have these places that are kind of indicated on this chart. The blue is the yield. So in other words, when you had that uptick in yields, stocks kind of went down. When the yields came back down, stocks went up. You had that inverse correlation. In other words, yields going up here, stocks go down. Yields come down, stocks go up. What's different now is that that's not really happening, right? You didn't have this uptick in stocks, this current cycle kind of mirrored by what's going on with yields. Yields have just gone pretty much consistently down with the expectations that the Fed is going to cut, and stocks had their rollover and rebound, kind of not seeing that similar pattern that we have had with rates before, which is an interesting change. And in fact, that's a change I talked to Rick Reeder about during the Opening Bid podcast earlier today. Rick Reeder, of course, the chief investment officer for fixed income at BlackRock, and he talked about the sort of interplay between stocks and bonds.
You can't price out of the markets have priced pretty much have split the difference between a 25 and 50. I would do 50. I think you got to get the funds rate to 4% quickly. And, you can't. I was looking yesterday at credit card delinquencies or charge-offs, auto loan delinquencies. Like, you're starting to see numbers that approach financial crisis. Not there yet, but you're starting to see this significant increase. 5 3/8 when you've got inflation running. I mean, I was looking at 3-month moving average. A bunch of the metrics are under 2 now, are under 2. 5 3/8 when you got inflation running, let's say 2. The wrong price. Like, get it to 4, which is still restrictive. So could they do it? I think they should. Do I think, you have enough difference of opinion on that committee that they probably will say, let's compromise and do 25s, consecutive meetings? I think that's Jan's base case, and that seems right to me.
So what Rick did talk about was the fact that he thinks fixed income is more attractive right now because of the sort of changing dynamics we've seen in the market, especially relative to stocks, who he says stocks are still going to go up, but he thinks valuations are getting a little stretched here, Josh.
All right, he's not the only one. Thank you, Julie. Appreciate it. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.